A silent move is underway in the Bitcoin market that the largest institutional players failed to predict. As capital rapidly drains from major exchange-traded funds, a critical $86,000 price level has emerged as the ultimate test of conviction. If this floor gives way, the institutional narrative that has driven this market could be fundamentally altered. This content is provided for informational purposes only and should not be considered financial advice. Market conditions can change over time. The opening weeks of 2026 have introduced a profound sense of uncertainty, a stark contrast to the aggressive optimism that characterized the end of the previous year. While traditional financial markets show signs of stability, the digital asset sector is currently navigating a significant and painful shift in investor sentiment. We have seen Bitcoin retreat from its recent all-time highs, leaving a substantial number of newer market entrants underwater and highly exposed. The prevailing market mood has transitioned from a phase of aggressive fear of missing out accumulation to a much more cautious and defensive posture, primarily due to persistent global macroeconomic headwinds that continue to pressure risk on assets. This is more than a routine market correction. It represents a crucial psychological turning point for the entire cryptocurrency industry. The institutional players, whose massive capital inflows were the primary engine for the recent rally, are now confronting their first serious challenge since the launch of spot investment vehicles. The atmosphere is thick with anticipation as market participants closely monitor the price action, watching for a decisive move near levels that were once considered impenetrable support. This environment of cooling institutional interest and the threat of cascading liquidations has created a highly volatile situation where every price fluctuation is intensely scrutinized. The central focus of the current market anxiety is a sudden and dramatic decline in the holdings of Bitcoin exchange traded funds. Recent comprehensive reports indicate that institutional investors are facing a massive test of their resolve, with fund balances plummeting by approximately $6 billion in a surprisingly short period. This rapid and substantial exodus of capital represents one of the most significant periods of sustained outflows observed since these financial products were made available to the public. The primary driving force behind this selling pressure appears to be a combination of the dissipation of the initial excitement surrounding institutional adoption and a strategic decision by large funds to reallocate capital into less volatile or more traditional asset classes. According to on-chain data, the net holdings across all major funds have decreased by over 8% from their peak values. This sharp decline is particularly alarming because it directly impacts the cohort of investors that was widely expected to establish a permanent, high-level floor for the price of Bitcoin. As these large-scale professional holders continue to reduce their exposure, the resulting selling pressure is generating significant downward momentum across the entire digital asset ecosystem. The market's attention is now laser focused on the $86,000 mark, which numerous analysts have pinpointed as an average cost basis or break-even point for the majority of these institutional participants. A detailed examination of the on-chain metrics and flow data provides undeniable evidence of the magnitude of this institutional retreat. According to reports, the U.S. spot Bitcoin exchange traded funds collectively recorded negative net flows totaling more than $1,137 million within a single 5-day trading week. This streak of 5 consecutive days of net redemptions is a clear indicator of the heightened caution and risk-off sentiment prevailing among professional traders. Furthermore, analysts suggest that while there are tentative signs of spot demand slowly attempting to rebuild, the overall trading volumes remain notably muted when compared to the high activity periods of the preceding months. The derivatives market, specifically the option sector, is also showing a distinctly defensive bias, evident by a significant increase in the purchase of protective put options as investors actively seek to hedge against the possibility of further price declines. As per recent data, a substantial amount of short liquidations totaling approximately $435 million is poised to be triggered if the price manages a decisive break back above $90,000. However, for the moment, the market momentum remains firmly in favor of the sellers. Additional data confirms that any minor inflows observed earlier in the month were completely overshadowed by the $1,300,000,000 in outflows recorded over the prior 30-day period. The current market dynamic is best understood as a classic conviction test for the entire institutional investment class. Analysts across the board emphasize that the $86,000 level is far more than a simple technical support line. It functions as a critical psychological barrier that will ultimately determine the viability and success of the current market cycle. Should the price successfully hold and consolidate above this crucial mark, it would send a powerful signal that institutional demand is indeed sticky and possesses the necessary resilience to absorb significant sell-side pressure without collapsing. However, the interpretations offered by expert commentators are notably polarized. One school of thought argues that this ongoing shakeout is a necessary and healthy cleansing process for the long-term bull market, effectively flushing out weak hands and reducing excessive speculative leverage before the market can initiate its next major upward move. Conversely, other experts interpret the $6 billion drop in institutional holdings as a definitive sign that the institutional honeymoon phase has reached its conclusion. According to market researchers, the noticeable absence of a strong, immediate bounce at these depressed price levels suggests that the prevailing market mentality of buy the dip is rapidly being replaced by a more cautious and opportunistic sell the rip strategy. The fact that Bitcoin is currently trading near $88,920 without establishing a clear directional bias indicates that the market is anxiously awaiting a major external catalyst, most likely in the form of new global economic data or policy announcements. Looking forward into the immediate future, the outlook for Bitcoin remains delicately balanced between a potential recovery and the risk of a much deeper, more painful correction. In the short term, specifically over the next 1 to 4 weeks, our analysis suggests that the $86,000 level will be subjected to multiple intense retests. A successful and sustained defense of this critical area could rapidly trigger a significant relief rally, potentially pushing the price back toward $95,000 resistance zone as short positions are liquidated and broader market confidence is restored. Conversely, a decisive and sustained close below $86,000 would likely open the floodgates for a rapid descent toward $80,000 level, where a much larger and more significant pool of long-term liquidity is known to reside. The most optimistic, bullish scenario is entirely dependent on a swift stabilization of the ETF flow data and a renewed return of consistent spot buying from established long-term holders. On the bearish side, the continuation of institutional outflows combined with any further deterioration in the global macroeconomic environment could maintain or even increase the current downwards pressure. Analysts widely suggest that the next 48 hours will be exceptionally telling, as the market's reaction during this period will largely define the prevailing trend for the remainder of the quarter. Given the current highly defensive positioning in the options market, a prolonged period of sideways consolidation, trading between $85,000 and $90,000 appears to be the most probable immediate outcome. This brings us to a crucial question for you, our audience. Where do you personally see the price of Bitcoin heading over the next month? Do you believe the institutional floor at $86,000 will hold firm? Or are we destined for a deeper retracement toward $80,000? The institutional landscape is currently facing its most profound and significant challenge since the introduction of the spot ETFs. As we continue to monitor these extremely critical price levels, staying fully informed with the latest on-chain data and market analysis is more vital than ever before. If you found this detailed analysis helpful and insightful, please take a moment to like this video and subscribe to our channel for more professional crypto news and insights. Thank you for watching.